Good morning, ladies and gentlemen, and thank you for coming to the Optional Retirement Plan Transition Meeting. It's my pleasure to welcome our guest speakers to VMI. I'd like to introduce from the Virginia Retirement System Defined Contributions team, Ms. Kelly Hires, Mr. Peter Thompson in the back there. We also have a representative from TIA here, Mr. Matt Mead. And we also have a DCP rep, Mr. Stephen McGregor in the back. Thank you all for coming today, and let's get started.
All right, good morning. Can everybody hear me okay? I'm one of those people, I can't stand the sound of my own voice, so I would prefer not to use a microphone if I don't have to. So if you guys can hear me okay, then I'm just gonna do it like this. Okay. If you can't hear me, let me know and I will be happy to use the microphone. All right, so as Ellie said, my name is Kelly Hires. I am the Defined Contribution Plans Administrator at Virginia Retirement System. So in addition to ORFI, I'm responsible for the 457 plan, the Virginia Cash Match plan, and several other, we have other optional retirement plans that are for different constituent groups. So we have a lot of different defined contribution plans. Today, I'm here to talk very specifically about the optional retirement plan for higher ed. So here is our agenda. The first few things that I want to go over are going to give you kind of a background on why we're making the changes we are making, what led up to those changes, and what we've done to prep for them. So we'll talk about that. Then, of course, we'll spend a good bit of time talking about the changes themselves and how they might impact you. And then I'm going to turn it over to our providers. So Steve McGregor from DCP will come up and talk about their program, and then Matt Mead from TIA will come up and talk about theirs, and then I'm going to close us out with just kind of a recap of key dates that you need to be aware of. Okay? So before we get too far along, there are a few terms I want to make sure we're all on the same page with. One is ORFI. That is a term I use on a daily basis, and I just assume that's what everybody else called it. When we went out and met with faculty earlier in the year, we realized that is not the case. So I want to give you a definition for that. ORFI is the optional retirement plan for higher education. It is a primary retirement plan laid out in the Code of Virginia for faculty members at higher education institutions. It is not your 403B plan. Your 403B plan is a supplemental savings program. You decide how much you put into that. ORFI contribution rates are determined by the General Assembly, not by Virginia Retirement System. Eligibility is laid out by the General Assembly, not by Virginia Retirement System, okay? So when I say ORFI, that is the plan I am speaking of. It is a 401A retirement plan. Some folks, if you're in the ORFI Plan 1, if you came to work prior to 2010, you're in the earlier version of the plan, which is all employer contributions. If you came to work after that, then generally you are in ORFI Plan 2, which is an employee and an employer contribution, okay? All right, second term is plan sponsor. The plan sponsor is the entity that is responsible for the administration of a plan. We own the plan for all practical purposes. We're responsible for administering it in accordance with various responsibilities I'll touch on in a few moments. VRS is the plan sponsor for ORFI. VMI is the plan sponsor for your 403B plans, okay? Plans can have the same provider. So say you have TIA with your 403B and you have TIA with ORFI. Because they are two different plan sponsors, they are two different plans. The fee structure, the investment lineup, and so on and so forth will vary from one plan to another based on the plan sponsor, the plan size, and other variables, okay? Different plans. Could be the same provider, different plans, okay? The other thing that I want to mention is record keeper. I'll use that term kind of interchangeably with the term provider as we work through the presentation. The record keeper is the third-party administrator that has been tasked with the day-to-day operations of the plan. They handle the call center, they handle statements, they handle education, so field representatives that come out and meet with you. They do, they process money coming into the plan, they send money going out of the plan. That is what the record keeper does, okay? Plan sponsor has oversight over the record keeper. So it's our job to make sure that the contracts are being upheld in accordance with performance standards and things that have been set forth. Okay, any questions on any of those? And I'm just going to throw this out there. This will be a much better presentation if you guys ask me some questions as we go along. That is what we are here for. You don't want to, this is a long presentation. It's around 70 or so slides. So it's pretty thorough, but it will be very helpful. If you have questions, just please speak up and ask them. That's what we're here for, okay? I would rather this not just be an information dump for you, so ask. All right, so management and oversight over ORFE. So the first thing I want to do is kind of explain to you where ORFE fits in with VRS. Why are we meddling with this plan? As I laid out, we are the plan sponsor for it. So VRS falls into the defined contribution area, or ORFE falls into the defined contribution area at the retirement system, which is my department. So we have a board of trustees that you hear about them in the news periodically. Board of trustees at VRS are all appointed by either the Senate, the House, or the governor. They have various constituency groups represented, including higher ed on the board of trustees. Under the board of trustees, you have various advisory committees. We have a very specific advisory committee that is responsible for the oversight of our defined contribution plans. We refer to them as DCPAC, simply Defined Contribution Plans Advisory Committee. Like the board, the DCPAC has representatives that are specialized in certain areas. So for example, we have 2 people that have expertise in the investment arena. We have 2 people with expertise in plan administration, and we have representatives for the various constituency groups of plans that we administer. So there is a higher ed representative. It is Rick Larson. He is at James Madison University. We have a local school K through 12 representative, and we also have a local government representative. I report to the DCPAC on a quarterly basis. So I fall here. And then we also have DC Plan's investment oversight. So the investment department that manages the defined benefit, the pension plan trust fund, they are also responsible for oversight over the investment lineup that is being offered to our DC Plans participants, okay? So my department, on the administration side, we're responsible for working on communications with the plan. We work on all the technology related to the plan. We handle reconciliations. We monitor contracts. We do performance monitoring, all of those various things. And on the investment side, they're doing very similar things with our investment managers, okay? So this is kind of where ORFE falls in, along with the other plans that we administer. Key fiduciary duties. As plan sponsor, we have a variety of fiduciary responsibilities that are laid out for us in the Code of Virginia. The primary ones I want to touch on today, there are others that aren't listed up here. The first is the duty of loyalty. We are required to do things for the benefit of our participants. We always have to look at your bottom line. It may not be the same individual bottom line. We can't always do everything that everybody is looking for. For example, we regularly get requests for socially responsible investments to be available in the plans. That means different things to different people. So we can't add all of those to our investment lineup. So we try to provide flexibility where we can, like the brokerage account that would allow somebody to get to those specific types of investments that they might be looking for, okay? We have 35 institutions in our ORFE plan, thousands and thousands of participants. So while we can't do everything that everybody wants us to do, we do try to build in some flexibility so that you can get to what you want, okay? Duty to follow plan documents. In addition to federal and state regulations, we have a variety of internal plan governance documents that we have to adhere to. The plan documents, master trust, and our investment policy statements. So periodically we'll get questions from people that want to know how did they pick the investments that they picked on the lineup. That is all laid out in our investment policy statement, and you can look at it online. It's available on the public website. Okay, and then the last one that I want to point out is duty of prudence. We have to do more than just give it our best good faith effort. We have to bring a level of expertise to the management of these plans. I have been working with defined contribution plans for over 20 years now, And collectively on my team, I probably have at least over 100 years of experience with these plans. We have a team of 13 people on the administrative side. So this is our job. This is our only job, is to manage these DC plans. Okay. Any questions on that? Okay. All right. So that's how the plan is overseen at VRS. But who's looking at VRS? One of our primary oversight parties is JLARC. Anybody in here familiar with them? Yeah, a few folks. JLARC is the Joint Legislative Audit and Review Commission, and they are a state agency that audits state agencies. They report to the General Assembly and the governor on VRS twice a year. And as part of that reporting process, they deliver a report to them in addition to a presentation on what's going on at VRS, how we're managing the plans, the pension plans, as well as the defined contribution plans. And I'll show you an excerpt from their most recent report on the next slide, which is one of the reasons that we are moving forward with the changes we're moving forward with. Okay, so separate from JLARC, we also have the Auditor of Public Accounts, and then we also have an internal audit department at VRS. Our internal audit department reports to our Board of Trustees. They do not report to our director or to our Chief Investment Officer. They bypass them and they report directly to the board. So they are treated as an independent auditor as well. And they audit ORFI at least once every 2 or 3 years. Okay. All right. So, JLARC, I hope this is big enough for you guys to see. I know Ellie printed some copies of the presentation. I don't know how well this particular slide photocopies. This report is available on JLARC's website. You can easily get it, as well as historical reports out there. It's published twice a year. The most recent report was published in July, and the next one will be published in December, I believe. Okay, so there's a few things that I want to point out. So JLARC looks at a lot of things related to our plans. When they look at the DC plans, one of the main things that they look at is investment performance. They look at how the investments that we are offering to our participants in our various plans are performing against their benchmark, all right? When you're looking at investment performance, and we'll spend a few more minutes on this when I get out off of this slide, but when you look at investment performance, you have to look at it against you have to have a comparison. You have to have an apples to apples comparison to determine how that investment that's available on the lineup is performing. You can't compare them one to another because they're different investments. They're different types, they have different objectives, and so on and so forth. So what they look at is they look at performance against a benchmark. The investment managers determine the benchmark. Okay, that's important. So this top section is the investment options that are available with all of the plans that we offer. These are the ones under the DCP platform. And you'll notice in most cases, they are all either meeting or exceeding the benchmark. So 10 out of the 10 investments that are offered have either met or exceeded the benchmark, all right? This is intentional because the investment options on the DCP platform, for all practical purposes, should be meeting the benchmark. The vast majority of them are what are referred to as passively managed investments, which means they're designed to track along with the benchmark. So when they don't, there's a problem, all right? Now, not all of them are. We have a couple of funds that are not passively managed, and so that's where you might see an occasional dip, okay? Now, when you look at the bottom section of this, these are the investment options that are currently available to ORFI participants, all right? Now, ORFI participants can use these investments. These have been available on the DCP platform in ORFI since 2017. TIA and Fidelity have been available basically as long as ORFI's been in existence, okay? And what you'll see down here is a lot more disparity in what's being provided, all right? So if you look here, within the last year, only 4 of the 10 investments available on the current TIA platform met or exceeded the benchmark. That means that 60% of the investments on that platform underperformed their benchmark. When you look at Fidelity, only 5 of the 24 investment options met or exceeded their benchmark. That means on the current Fidelity platform, 80% of the investments that are available underperform their own benchmark, all right? What they've stated, this is our benchmark, this is what we're comparing ourselves to. This is not a fluke. There is a track record going back over time. All right. This is one of the main reasons that we are pushing forward with changes to the investment lineup available on the TIA platform, and we're removing Fidelity. Okay? This is a key factor. We are accountable for this. Are there any questions on this? Has anybody ever looked at a JLARC report before? No. Generally speaking, it's not very interesting reading, but it is interesting if you're looking at it in context of why we're making these changes. Okay. Mm-hmm.
Who sets the benchmark, and the fact that the new plans that you're showing are showing that they are meeting the benchmark, is that a factor of perhaps the benchmark having been lowered?
No. The investment managers themselves, so when Fidelity creates, say, the Fidelity Freedom 2020 Fund, they look at the types of investments that they're putting your money in, and they create a benchmark that matches that. So that's determined by the investment manager themselves. For the DCP options, like I said, there are not all of them. There's, I think, there's 3 of them that are actively managed investments. And an actively managed investment is basically where the investment manager says, here's our benchmark, our goal is to beat it. So it's determined by the investment manager. It doesn't change unless the underlying investments that they are investing in changes. Does that make sense? And if you look, TIA has an investment performance report. You can go out to the VRS TIA website and pull down their investment performance report and see this information for yourself. DCP has a monthly investment performance report. For Fidelity, though, you have to go and look in all of their individual investments. They don't provide a consolidated performance report. So you have to look at those individually. And most people don't look at investment performance in this manner, and we'll talk about why. When you think of investment performance, what do you think of? You think of your little rate of return on your quarterly statement, right? That is your personal rate of return, all right? When you log into your account, you see, oh, I earned 13% last year, I'm doing great, right? From a plan perspective, we have to look at investment performance of the fund, all right? Your personal rate of return takes into account you're buying shares every 2 weeks, you're moving money around, all of those various factors. So your personal rate of return is going to be different than pretty much anybody else's, because it's going to be a factor of your personal activity within your account, okay? From a plan perspective, we have to look at a bigger picture. Okay, so investment managers put together what's referred to as an investment performance report. Okay, basically shows the performance of a fund over a fixed period of time, year to date, 1 year, 3 year, 5 year, 10 year, and so on and so forth. Okay, that's what we have to look at. This is a very different thing than when you pull up your quarterly statement. Quite regularly, and even especially over the last few weeks, I've heard from people that have said, oh, I'm very happy with how my funds are doing. They're doing great. I earned so-and-so % last year. But when you look at what that investment that you're in, how it's performing against their own apples to apples comparison, that's a concern, okay? All right, so when you're looking at investment performance reporting, I just said some of these things, so I'll repeat this. Performance data, you want to look at how an investment performed year to date, 1 year, 3 year, 5 year. Historical performance doesn't guarantee future performance, but it certainly is a good indicator. And it's something that we have to take into account. So separate from the investment performance for the fund you're in itself, you should also be looking at benchmarking information, all right? For every category of the market that you could be putting money in, there is an index. There is a benchmark for it. The index is generally the benchmark. So when you're talking about, say, a large cap stock fund, that's large US stocks. One of the main benchmarks for that area is the S&P 500 index, which most people are familiar with. You've heard that terminology. There's all kinds of other various benchmarks or indices that are out there. That represent other pieces of the market, okay? So you want to look at how your investment's performing. You want to look at what its benchmark is and how its benchmark is performing over those same periods of time so that you have a comparison for how your investment manager is actually doing. And then you want to look at fee and expense information quite regularly. Well, most people anyway, when you see an investment expense ratio of 0.48%, that probably means very little to you. So we also like to see that information reported as a dollar amount. So what does 0.48% actually translate to in an account balance? So we do like to see that information, and you should look for that as well. Okay? And then of course, investment performance reports should include any kind of trading restrictions or other types of fees that you might incur in your plan. Okay? Any questions on this? How many folks have ever looked at an investment performance report? A few folks. Okay, very good. Good. As I mentioned, if you go to the TIA VRS website. So you got to go to VRS's ORFE website, and then you can click into TIA's account. And on the investment page there's a link to their quarterly investment performance report. If you go to the general TIA website, you won't find that information. Okay, so you got to go through the VRS site to get to that. So it'll show you a performance report for the funds in our plan. Okay, and then on the ICMARC or the DCP platform, under the investment page, there's a link to those monthly reports. Okay, any questions on performance? Nope. Okay, we're jumping into fees now, which is a little more numbers I'm going to throw at you, so bear with me and please speak up if you have questions. Fees quite regularly, again, seem very tiny, as I mentioned, and they seem inconsequential. They have a big impact, though, especially when you're looking at it from a career, long-term perspective. So fees are important to us. They are equally as important as performance because they have a very significant impact when you look at a long-term career. And I'll show you an example of that in a minute. Generally speaking, all retirement plans have fees. It costs money to run a call center. It costs money to send out statements. It costs money to have folks like Matt and Steve come out and sit down and meet with participants. It costs money. So there are fees associated with plans. There is a cost to be a record keeper, all right? In addition to that, there are costs related to the management of the actual investments themselves in the plan. So the people that are doing the research, buying the shares, all of those other various things that are going on, the ones that work for BlackRock, the ones that work for TIA's investment management people, there are fees related to the underlying investments in the plan. In many cases, those fees are intermingled and you can't really tell them apart, but they do very different things, okay? When they're commingled, it's called revenue sharing. There is a portion of the investment's expense ratio that pays the record keeper, okay? So it's hard to tell that you're actually paying those fees, but you are, they're there, okay? So you have investment management fees. Generally, these are a % of assets. This is the expense ratio that's associated with your investment, and then you had your record keeping or your administrative fees. As I mentioned, in a lot of cases, they're commingled and they're all under one expense ratio, okay? Plan sponsors can work with their record keepers and say, we want to return any excess revenue that you're pulling in off of these investments and give it back to our participants. That's called a revenue credit. Okay, so they give back what's over and above what they actually need. Okay, other ways to do it, there can be just a flat dollar fee. It doesn't cost any more for TIA to record keep a plan with $500,000 in it than it does for TIA to record keep a plan with $100,000 in it. It costs them the same amount of money to provide those services to the plan. That's why we charge, a few years ago, we moved to a flat per head fee. Okay? Because when it's percent-based, your people with your higher balance are entirely subsidizing the people with the lower balances in the plan. But they're getting the same services for it. Okay? Now, other types of fees, you have things like 12B1 distribution fees. How many folks have an IRA or a brokerage account outside? A few of you? You know those fun prospectuses that you get in the mail, like this thick, and you get them all the time? That's what 12B1 distribution fees pay for. Those are marketing fees, and they are embedded in a lot of investment expense ratios, okay? We don't get that kind of stuff in this plan, so we would prefer you not to pay those fees. Other things are surrender fees, transfer fees, mortality and risk fees, acquired fund fees. I'm not going to go over all of those individually, but we do have investment information that explains all of those and tells you specifically what you're paying in the investments that you have in our annual fee disclosure. So all that detail is out there. You're welcome to go look at it. I would encourage you to do so. And then another thing I want to point out is implicit versus explicit fees. That's a tough one. Explicit fees you see deducted from your account balance. It's easy, you know they're there, you see exactly what you're paying. Implicit fees are the ones that are embedded with the expense ratio. They're percent based, they're deducted from your earnings, they reduce your returns, okay, but you don't actually see them come out. Okay, all right, so as I mentioned, those little fees seem inconsequential and people don't think they really make much of a difference. Long term, they do. So in this example, we have two people. They're contributing the same amount of money over a 40-year period of time. They're earning the exact same rate of return. So for all practical purposes, they should have the same amount of money in their account when they retire, right? The difference is this. Investor A is paying 0.5% and investor B is paying 1.5%. Investor A, at the end of a 40-year career, has around $350,000. Investor B, on the other hand, has $270,000. The only difference is the fees, okay? That is a 30% difference. It's big. So again, while they don't seem huge when you look at them on a piece of paper, long-term they have an impact. It's important. That's $80,000 difference in retirement savings because of that. Now, when I have gone over this stuff with folks in the past, I regularly get, well, my investment's earning more. I like it. I want to keep it. I don't care if it's charging me a little more money. Your investment would have to earn 17% more in order to make up that 30% difference. I don't know any investments like that. So again, it's important, all right? Now, so what I wanted to do is give you an example of how this varies across the platforms we have now. I wanted to give you some actual breakdowns that show you a fund that we currently have available and what the impact is to your bottom line, okay? So I picked the money market fund because the money market fund on the DCP platform, on the TIA platform, and on the Fidelity platform all have the same benchmark. They all use the Bloomberg Barclays U.S. Treasury 3-month index. That's the index that all of these three are benchmarking against. That means that it's an apples to apples comparison, right? Okay. Now, for these examples, we're keeping it simple. We're assuming $100,000 invested in this fund over the course of a year, okay? This is not personal rate of return stuff. We're looking at a fixed period of time, just to simplify things. So in the BlackRock Money Market Fund, which is the one on the DCP platform, this will also be the one come January on the TIA platform. It's the same fund on the TIA platform starting in January, all right? That fund, all in, has a bottom line cost to you of $111 a year, okay? If you look at the Fidelity Government Money Market Fund, again, same benchmark, same type of investment, actually has a lower rate of return. This one is a 1.3 return, this one is a 1% return. Bottom line cost on the current Fidelity Money Market Fund is $280. That's a big difference. When you look at the CREF Money Market account, which is available on the current TIA platform, and this one's a little more complicated because the cost to you depends on whether you're in the old contract structure or the new contract structure. So let me take just a second and explain what I mean by that. So in 2017, we switched the plan to the RC contract, which is this one down here. All right, so all contributions going to TIA since January 2017 have gone to the RC contract. Prior to that, contributions were in the GRA contract. okay? The GRA contract is over 80% of our assets with TIA are in that old contract, and we can't do anything with those. So that fee structure is what it is. So if you have assets in both, you're probably paying both, okay? So in the GRA contract, the CREF money market account, which has, for the same time period, as a 1.1% earning, the GRA contract's costing you about $225 a year. The RC contract about $191. So again, the cost structure of the plan, the investments, the record keeping cost, all of those different things vary a good bit from one plan, one provider to another. Are there any questions on this? So we've had questions come up in some of the previous meetings. How do I know which of these contracts I'm in? If you are currently with TIA, any money that you've been putting in since January 2017 is going into the RC contract. Money that went in prior to that is in the GRA contract. You can consolidate them if you want. You can move the old money into the new contract. You want to talk to TIA, look at the different plan details, and go over the options with you. You can see in some cases it may be cost beneficial to you to simply transfer that money to the new contract. Okay. All right, so separate from fees, servicing. We expect, VRS is a large plan. We expect a lot from our record keepers and our providers. One of the things that we expect is on-site availability. We expect our record keepers to be able to go out, go to benefit fairs, sit down with individuals that are in the plan, talk to them about their account, go over their options, explain what a target date portfolio is, all of those different things. We expect that from our record keepers, okay? TIA provides that service. ICMARC provides that service for the DCP platform. Fidelity no longer provides that service. That changed in January, or not January, when was that? June 2017. TIA had a change in their, or Fidelity had a change in their business model, and they no longer provide that service. So they won't come to your benefit fairs. They won't send somebody to campus to sit down and talk to you. You can't even go into a retail location and talk to their folks about your plan. That's a big concern for us, okay? In online and by phone, of course, those are also expectations. We expect robust participant resources. We expect calculators. We expect planning tools. We expect all of that stuff from our record keepers, okay? We expect a self-directed brokerage account. That's a key piece of what we want to provide our participants because it gives you some flexibility. Okay. Reporting. Obviously, participant statements are actually not a VRS expectation. That is a legal expectation. Record keepers have to provide participant statements. We expect investment performance reports. That is something that TIA has available on their platform quarterly, as I mentioned, and ICMARC provides it on the DCP platform on a monthly basis. Fidelity does not provide that information. Data exchange, this is behind the scenes. It doesn't mean a whole lot to you as a participant in the plan, but it is a very important component of managing a plan as complex and large as the DC plans that VRS is responsible for. So that is a key thing that we have to take into account as well. Educational materials, occasionally there's things like National Retirement Security Week, there's Retirement Awareness Week, there's all kinds of different things that we like to be able to do custom communications campaigns for our folks. We actually just did one on beneficiaries not too long ago. So those are things that we expect. We also expect, this is a basic thing now, online, by phone, and mobile. So, and all of the providers do have that as well. So these are the services that we expect our participants to be able to receive from their record keepers, okay? Plan portability. This is a little off the path that we've just been on, but I think it's important because over the years I have received many questions about this. Plan portability. When you leave VMI and you go to work somewhere else, or when you left somewhere else and came to VMI, you should be able to take your retirement plan with you. And that is based on the type of plan that it is, not who your provider was. Okay, if you, as we talked about earlier, if you have 2 plan sponsors that both have TIA, so if you came here from, I don't know, somewhere in Texas, for example, and you had TIA there, you have TIA here, it's still 2 different plans, 2 different cost structures, 2 different investment menus. So it might be under the same provider. When you log into your account, you might get a total balance there that consolidates those amounts, but they're different plans. Very different plans, okay? In some cases, drastically different. So just because it's the same provider does not make it more or less portable than if it's not the same provider, okay? So you can take your IRA and roll it here. When you leave employment, you can take this plan and roll it to your IRA. If you go to a different employer, you can take your ORFI, your 403B, your 457, all of those different plans will roll right along with you to your new employer. Okay? Now, there may be differences based on the types of investments that you've selected in your plan. So that's something that you need to be aware of. But other than that, they are generally speaking pretty portable. Okay? All right, so our changes that you guys are all here to hear about. Hopefully what we just went over kind of helps you understand why we are here. We had some basic goals that we wanted to set forth with we had all of these in the back of our mind as we've kind of worked through this project from its beginning stages last year. We wanted to maximize services that are available. As I mentioned, Fidelity doesn't offer on-site services anymore. That's a concern for us, okay? We wanted to make sure that we are minimizing cost and we're improving transparency. And when I say improving transparency, I'm not only talking about being able to see that you're paying $66 or $30 a year for your plan administration. We're talking about the investment expenses as well. As I mentioned, that expense ratio can include all kinds of different things. We would prefer that the investment expense ratio be for investment management, and that's it. That is our goal, to make that very simple. So when you look at that number on a piece of paper, you know exactly what you're paying for. Okay? Provide an updated menu and focusing on fund structure, performance, and fees. As we talked about earlier with the JLARC report, we have to account for the fact that those investments are consistently underperforming their benchmarks, and we have to make some updates to that, okay? Considering recruitment and retention needs, we have talked to faculty, we have talked to HR staffs, we've talked to finance officers. We understand that there are certain things that are important to the higher ed community to be able to keep up with recruitment and retaining employees. So we wanted to keep those types of things at the back of this project the whole time as well, okay? And then of course maintaining open lines of communications. Our goal with this project has been to be as upfront about it as possible, as what's going on. As soon as we had a decision from the Board of Trustees in May, we sent out notifications to everybody that there were changes coming. At a high level, here's what they are. Stay tuned, we will be out and about with meetings, okay? So, last year in the fall, we sat down with employers and we talked about our concerns with the plan. We talked about things that we would like to potentially see changed with it, problems that we wanted to address. We talked to them about how faculty would respond to those types of things, and we asked for suggestions and recommendations for how we might move forward with something like that. One of the suggestions that came from those groups was to actually invite faculty members to an actual meeting and sit down and talk to them in small groups around the Commonwealth. We've done focus groups in the past and nobody came. We've done surveys and people don't respond. So we've done meetings like this and people don't come. So we took that recommendation and we asked HR give us some folks that will talk to us, ask us the hard questions, and would be engaged and willing to sit down and talk to us about this plan. And they delivered in droves. We actually had a very good meeting here at VMI. I think we probably had around 6 or 7 faculty members that came to the meeting here. So we did all of that. Armed with feedback from those meetings, we started working on some recommendations that we put together. We presented them to our advisory committee in late April, early May. Advisory committee approved them, sent them to the Board of Trustees. They approved them, I think, on May 3rd. Within a couple of days, we had postcards mailed out. Our website was up and running on the day of the board meeting. As soon as we got the word that they approved it, we pulled up the website. And that information has been out there since then. We also sent notifications to the faculty members that attended the meetings that we conducted, and our employers have been involved in the process all along with communications and moving forward. So, aside from feedback from faculty and human resources personnel, we had several things that we had to take into account as we looked at what we wanted to do. One of the primary things, as I mentioned, Fidelity's lack of on-site services. We also wanted to look at the availability of investments through a brokerage window. So if we removed one of our record keepers, could you get those investments somewhere else within the plan? All of the Fidelity investments are retail investments for the most part. You might not be able to get the exact same share class that we have because we're institutional, but you can get the Fidelity Extended Market Index Fund, you can get the Fidelity Freedom Funds. They're all available through the brokerage window. So if you just really like those funds, you can still get to them through Orphe, okay? There's going to be some different costs associated with it, but you can get them. Over half of our Fidelity participants have left employment. Over half of them have separated. They can just roll their money out to something else. They can roll it over to an IRA with Fidelity if they want. Okay? So that's over half. Provider share, some feedback over there. Provider share of assets and accounts. This is probably less of a concern for you as a participant in the plan, but it's a huge concern for us as the plan sponsors. As you probably are aware, if you have more money, if you have more skin in the game, you have more leverage. So VRS administers over $5 billion in DC plan assets across all of the plans that we're responsible for. TIA accounts for about 16% of those assets. Fidelity accounts for less than 5%. If you look at TIA or Fidelity has about $230 million in assets in Orphe. That's it. It's a small plan. TIA has around $880 million in assets, I believe, and the rest are with the DCP platform. Okay? So that is a concern for us. We have very little bargaining power with $230 million in assets in that plan. When we look at participants, less than 25% of our Orphe participants are with Fidelity. The vast majority are with TIA. Okay? So those are things that we have to take into account at the plan sponsor level. Okay? Less concern for you, but a big factor for us. Okay? And then the TIA investment lineup, of course, you looked at the JLARC report. We have to account for that as well. So we're making some updates to the TIA investment menu to provide better performing investments. We're also looking to improve transparency in fees and reduce revenue sharing. Those things we talked about with the fee structure earlier, the 12B1 distribution fees, mortality risk fees, those things are present in most of the current TIA lineup. They are not on the new TIA lineup. Okay? Any questions on that? All right. So in addition to those things that are very specific to our plan, we also have a responsibility to know what's going on in the industry. Again, this is our job. My job is to administer these defined contribution plans. I don't do anything else. This is all I do every day. All right? So I have to know what is going on out in the industry. I have to know how our plans stack up against our peer plans. We benchmark our plans regularly. We know how our plans are performing against other plans. Okay? Those are things that we look at. We also have to know what's going on in the industry just in general. Right now, if you go out and you Google retirement plan fees, you're going to find all kinds of interesting information. This is a very, very interesting time for employer retirement plans. A lot of activities going on. VRS is not alone in the changes that we are making. There are some very, very high-profile changes going on right now. Duke University, Yale, Cornell, Brown, Vanderbilt, lots of different retirement plans are reducing the number of record keepers that they offer, and they're making changes to their investment lineup. And they're doing them for very similar reasons to what we're doing them for. okay? We're not alone in this. All right, so any questions on any of that? Because now we're going to jump into the actual changes. Nope, okay. So in June, we removed Fidelity as an option for new hires. So employees that have come into the ORFI plan starting in June no longer had the option to pick Fidelity. They only had the option to pick either TIA or DCP. Okay, that occurred already. In January, we're going to jump forward to the next big piece of the change, and that is in January, we're changing the TIA investment menu, and we are closing off Fidelity as an option for everybody. All right, so starting in January, you will no longer be able to use Fidelity as a provider. Okay, so you have to make new provider elections. Okay, so folks that are here that are with Fidelity, that is something that you have to do now. All right, so where we are now is in kind of a building point to get to those 2 January landmarks or milestones. Okay, so we're in open enrollment right now. If you have Fidelity, you should log into MyVRS and select a new provider. Okay, it's myvrs.varetire.org. It's in all of the materials as well. You should log in there, you can see your options, you can look at the investment lineups, all of those different things, and you'll need to pick a new provider, which will be effective in January, okay? Also during this window, if you have Fidelity, you have the option to say, I want to leave my money with Fidelity, okay? There's a form that you'll get in MyVRS. It's in the process, there's a link to it, it says if you have assets with Fidelity, make sure you read that paragraph. Because in that paragraph is a link to the form. It's a pretty simple form. Basically, you're just checking a box and signing it and sending it back to VRS. And that will tell us not to move your money with Fidelity. Okay? And then in February, people with Fidelity that have assets that are actually moving from Fidelity, again, just because you have Fidelity doesn't mean this impacts you. If you have money moving to either TIA or to DCP, it will move in February, okay? And there are two main pieces of information that were sent out at the end of September. This is the transition brochure. This provides basically an overview of all of the changes that are occurring, okay? It gives you the updated investment menu for TIA, which Matt will speak to in a few moments. And then the Fidelity insert, if you are with Fidelity, if they are your current provider or you have a previous balance where they used to be your provider, you should have received this one. This one has a timeline right on the front and some additional information that's specific for Fidelity folks, okay? All right, so as we worked through this, we wanted to make sure that we were providing participants in the plan that would be impacted by these changes with choices wherever we could. So we wanted to offer participants with Fidelity the ability to leave their money there. Okay, again, you fill out, yes, Allie?
Kelly, I just wanted to, if we could repeat what you were talking about as far as when you go into MyVRS. So if you are moving your existing Fidelity fund, for example, and you want to starting in January, to go with TIA, for example, you would just be filling out, selecting TIA, doing the one transaction, right, on MyVRS? Okay, but if you're leaving your Fidelity funds, you need to fill out both forms.
Yeah.
Okay.
So you got to think of it, so for Fidelity folks, this is kind of a two-part process. You need to think about it in terms of who your new provider is going to be. That's what you're selecting in MyVRS, all right? And then you need to think about whether you want to move your money with Fidelity or not. If you just select a new provider in MyVRS, your money with Fidelity will go to your new provider. So if you pick TIA, your Fidelity money is going to move to TIA. If you pick DCP, your Fidelity money is going to move to DCP. If you do absolutely nothing, your new provider will be DCP and your money will move to DCP. We would really encourage you to actually make an election though. We would rather people not default, okay?
These funds are, it's the 403A.
There's 401A.
Okay, is that what we're talking about?
We're talking about ORFI.
The ORFI. So if I have the other funds, we were just talking about.
Yeah, we're only talking about that. There's no impact whatsoever So you guys probably have 403B plans with Fidelity, all right? And you also probably have a 401A plan with Fidelity. That's the cash match that's associated with it. There's no impact to either of those.
Okay.
This is just your optional retirement plan for higher education, okay?
No matter when I make the election, ma'am, it won't transfer until February.
That is correct. Yeah, there, as you might guess, this is a relatively complex transition. Lots of moving parts and pieces, and we wanted to make sure that we provided some flexibility for participant choice, which adds additional layers of complexity to the process. So that's why there's a delay. We want to make sure that when we actually move the money, we've got our I's dotted and our T's crossed, and we need time to do that. So having said that, you can move your money anytime you want. You can do a plan-to-plan transfer anytime you want. That's not an issue. So if you want to do it now, you can, but you're still going to have money moving until the end of the year, going to Fidelity. Okay. All right, so the form, it's called the Fidelity Asset Transfer Election Form. It can be mailed, it can be faxed, or it can be sent snail mail, whatever you prefer. We would prefer fax or email. We intentionally designed the form so that it doesn't include too much personal information on it, so you can send it by email if that's your preference. It's easier for us as well, okay? Fax also goes to a designated, it comes to our processing team.
Kelly, do they need to know our BMI plan number on the form?
There is only one plan number for Orphe, and I am not sure exactly which it is. If you have questions, let us know. Peter, you don't know the Fidelity plan number, do you? 897. Huh? Of course you do.
Kelly, one thing I'll add, for those of you who, if you haven't gone into my VRS yet to make your provider selection, there is, it's a 3-step process. First, when you log in, you'll be presented with a banner on your MyVRS homepage. After you select your provider and hit the next button, there is language on that next screen, which is the confirm screen. And there is a link to the PDF, the election form, on that screen. It's a fillable PDF. You can download it. You want to do that before you submit your provider selection. Once you've submitted your provider selection, you will not be able to get back to the form. If you've already done that, you can definitely reach out to us at orphe@varetire.org. But you want to make sure when you're on that confirm page that you download that PDF, fill it out, and you can, as Kelly mentioned, you can email, fax, or send it to us snail mail.
Thank you for that, Peter. Another thing I want to point out too, this is a question that's come up a handful of times, is what happens with my money if I leave it with Fidelity? It stays exactly where it is. Basically, we are deselecting Fidelity as a provider, which means that VRS will no longer have oversight over that plan. We are saying we are done with our fiduciary responsibility with assets with Fidelity. That's what's happening. Fidelity can't add investments and they can't remove investments unless the investment is no longer available. So if they close out a fund entirely, then it could be removed from the platform. But for all practical purposes, what you have right now is what you have going forward.
So you're moving the funds in February, but actually January 1 is when the...
Yes, we'll come back to that in just a moment. And there will be a few different timelines. So you'll select a new provider no later than November 15th, okay? That's step one. Your contributions will start going to that new provider on January 16th. Okay? And then the assets, meaning the money that's already with Fidelity, will move in February. Again, lots of moving parts and pieces. Yes, I understand. So that is important. Because you are leaving your money with Fidelity, if you choose to do that, that does not make you eligible for a distribution from the plan. I've had a handful of people that have called me and said, well, my Edward Jones advisor told me I could roll that Fidelity money out into my IRA. That is not the case. I'm not sure where that came from. That is still part of the Orphe plan, and until you leave employment, you cannot take it out. You can move it to a different provider. So if you decide right now that it's a pretty lengthy time between now and February when the money will actually move. So if you are concerned about that, then you may want to leave it with Fidelity for the time being, and then in 6 months, do a plan-to-plan transfer and move it at that point in time, okay? All right, any other questions related, anything else that you've gotten, Ellie, that you think I should mention?
No, I know the process works because I've already done my selection.
We've had a lot of them already go through.
I handle it on my phone in about 5 minutes.
Oh, that's fantastic. You're the first person that I've heard that's used it on their phone. That's awesome. Very good. All right, so for TIA participants, as I mentioned earlier, we have multiple contracts with TIA. Money that is with TIA that was pretty much contributed up until 2017 is in an older contract version. Okay, it's the GRA or the RA contracts. We can't do anything with that money. So that's literally over 80% of our assets with TIA are not impacted by the changes that we're making. So for all practical purposes, it's only the money that's gone in since 2017 that is moving to the new investment lineup with TIA. If you want to use the new investments with in the RC contract that are coming, you have to transfer money from the GRA or RA contract to the new contract, and that's something that TIA can help you with, okay? All right, in some cases, it may make cost sense for you to move money to the new contract with TIA. In some cases, it may not. Again, I would encourage you to sit down and talk to Matt or call TIA's call center, which is very capable of helping you with these questions as well. All right, so open enrollment, I'm going to skim through these next slides because we've already covered this. I do want to quickly mention that open enrollment is not just for Fidelity participants. Every year we provide an open enrollment window. It's usually just the month of October. We've extended it a bit this year to give folks a little more time. But open enrollment is always an opportunity for you to change your provider going forward. So every October, including this year's open enrollment, you can log in and you can say, I have DCP now, I want to change it to TIA in January, or I have TIA now and I want to change it to DCP. So that is your opportunity to do that on an annual basis. That does not move your money. All right, that only changes where your contributions are going. So if your provider now is either DCP or TIA, you can change your provider starting in January, but it doesn't impact the money you have with DCP or TIA. Okay, is that clear as mud? Okay, all right. Resources, how many folks have been to the website? Two, you There's a lot of information out on the website. As I mentioned earlier when we started, this is a very long presentation, so we didn't print out. We figured we'd save a few for us to not print out copies of the slide deck. But you can get them when you go to the Orphe 2020 webpage and the websites and all of the materials that were sent out. But if you go to the website and you click on Orphe 2020, there's a link to transition meetings. There are recorded versions of my section, TIA's section, and the DCP section. So you can go back and re-listen to this. They're going to be shorter because they're shorter recorded versions. I think mine is 30 minutes. And then there's also a copy of the PDF that you can download. All right, so the information that we're going over today is available in both a recorded format and a printable presentation format. Okay, so you can go get that. And then with that, are there any questions for me before I turn it over? Nope. Okay, so now I'm going to turn it over to Stephen McGregor, and he's going to talk to you about the DCP platform.
All right, good morning. Thank you for having me here today. I know you just heard about all the parts about the Orphe transition and what's going on, but really this part of the presentation is really directed to the DCP part. So it is a roadmap. Some of it is redundant, but hopefully you'll learn a little bit more about the DCP option once I am finished. So first off, what's not changing? Number one, eligibility requirements, that's not changing. Number two, assistance from reps that are local, whether they're TIA or if they're from ICMARC, diversified investment paths, and then state-of-the-art DCP resources. So what is changing? We've already gone through this, but really if you have Fidelity as your provider now for Orphe, you got to make a choice. If you don't make a choice, something still happens, so I think you're aware of that. If nothing is done, it will convert to DCP. So really our role, she mentioned the difference between a service provider as well as a record keeper and a plan sponsor. ICMARC is the third-party record keeper for the Orphe plan. We do all day-to-day administration for the plan. We also provide education, and that is my role. VRS, they do the due diligence, fiduciary responsibility, and actually pick the investments and monitor them as well. So really, if you want to know who we are, anybody heard of ICMARC before? You have? Okay, good. Anybody know what it stands for? Okay, well, it stands for International City County Managers Association Retirement Corporation. In Albemarle County, city managers decided to start a company in the public sector for people in the public sector, a retirement corporation. So that's our bread and butter. That's where it started in 1972. There's 8 VRS plans that we are actually the record keeper for, besides the Orphe, including Commonwealth of Virginia 457. We are a nonprofit company. We have 180 plans outside of VRS in Virginia, 457 plans, with 45,000 participants and 180 plans. Let's see, 53.3 billion total assets, and we do cover 49 states and 5,000 municipalities. So really, I guess the bread and butter is public sector is where we created. That's really what we're focused on, and that's what our experience is. But we do offer 403Bs now too. So enrollment, staying with DCP, that's easy. You don't have to do anything. Nothing changes really. Everything does like it has been in the past. But if you're switching from DCP to DCP from TIAA, of course you'd have to go in and elect your contributions. Go to myvrs.varetire.org. Just like Peter and also Kelly mentioned, you go in there and make your election, so hopefully everybody will do that. If you want to move your account balance, remember that email address, orphe@varetire.org. And they also mentioned you can transfer at any time. This could happen years from now if you transfer one balance to another. Switching from Fidelity, you have that one extra step. You have to decide what you're going to do with your existing money, but same thing, sign into MyVRS, move your account balance if you want to by doing a fund transfer. And then also, if you want to leave your account balance, that's the one thing where there's that additional form, that Fidelity Asset Transfer election form. Deadline's a little bit different for that transfer of assets for existing money. That's the 30th. For the elections, you know it's the 15th is the deadline. I'm not trying to go too fast. It's just the same information over again. But anyway, if you do have money transferred from your existing plan to DCP, that'll happen right around in February. Your funds will move through this fund mapping schedule, and it's on the table over there. I have a copy sitting right here, but if you're wondering if I'm in a Fidelity fund, where it's going to go when it goes to DCP, it's actually on this sheet. We also list the expense ratios between the two different funds. So if you're not sure where it's going to go, you can kind of map it out that way and see where your investments will be invested once they are transferred. We will go through the investment section for the generic plan and what your options are. Know that if you're starting your contributions in January, there is a default investment election, but you would want to log in and maybe adjust things if there's something different you want to choose. So that brings me to the investment options. And I have this guide on the table, the screen guide, the investment guide that goes through this. But the way the investment choices are organized is they're called the pathway method. It's called the do it for me, the help me do it, and the do it myself path. So 3 pathways. They did this to make it easy for people to choose, make it easy to choose what their style is, their goal, reach their goals. Hopefully everybody can get what they want through these 3. We'll go through all 3 of these, but just high level. The do it for me path is good for somebody who knows they want to be invested, knows they want to be diversified, but they don't want to take the time and effort to actually pick the investments underlying it. We'll go through that. They're target date funds. The help me do it path, that's for somebody who wants to take a more active role. They either want to take risk or not take risk. There's 10 different investment options they can pick and choose from. Last but not least, you do have a self-directed brokerage window. That's the do-it-myself path. That's for somebody who probably knows what they want and can't find what they're looking for in those other two pathways. But you can be in all three, and I'll cover each one quickly. So the do-it-for-me path, excuse me, are the target date funds. BlackRock Investments is the company that actually manages these, and what they do is they build an investment portfolio, stocks, bonds, real estate, commodities, with the idea that you're retiring on a specific target date. In other words, the more time you have, if I'm in the 2060 fund or 2065 fund, BlackRock will be taking a lot more risk because they think you have a lot of time until that point. But all of these funds will slowly get more conservative over time. When they do reach that target date, they turn into what's called the retirement portfolio. At that point, it's moderately conservative and it's a static model, really designed for people in retirement. So they start off aggressive and get more conservative over time. They are well diversified, set it and forget it type investment. What's underneath the investment selections, if you wanted to know what is in there, I have these sheets over on the table, and the DCP plan specialist like myself, if you want to know what the actual mix is, it's actually on these sheets. If you are selecting new contributions to go to DCP, and you don't decide what your investments are going, guess where the default is? The do it for you path, and they will assume that you're retiring on the target date that's closest to age 65. So if you know you're retiring at 60 or 70, you may want to adjust it if you want to use their model the way they have it designed. But you can be in any target date you want. Just know that that's what these are. Any questions about target date funds? Most everybody's familiar with them at this point. All right, for the Help Me Do It path, 10 different investment options that go from low risk to high risk. You have 2 capital preservation funds, the money market and stable value. You have 3 different bond funds. That first one is investment grade bonds. You have an inflation-protected bond fund, which is invested in TIPS. They're tied to the consumer price index. And then you do have a high-risk bond fund or high-yield bond fund to choose from. Then we get to the fun ones. The stock fund is the S&P 500, so that's that large U.S. company stocks. You have a small mid-cap stock fund, which is the Russell 2500 index, so your small and mid-sized U.S. companies. International stock fund is outside the United States everywhere, so developed and emerging markets. There's a real estate fund that is a global REIT fund. And last but not least, we have the VRS investment portfolio. That is the same investment management style as the pension fund for VRS, the VRS Trust. So the people are in the Plan 1, Plan 2, VRS manages those assets. You can actually have the same style inside of your ORFI plan or your 457 plan if you have that. Invested the same way as a VRS trust, but it's in a separately managed account. And they're about a third stocks, a third bonds, and a third alternative investment strategies. But that's a choice as well. So really, you can be in any pathway. There's no cost to switch between the Help Me Do It path and the Do It For Me path. And information is on the table, and you can look at those at your leisure. So last but not least, the Do It Myself path, that is a self-directed brokerage account. We use a TD Ameritrade account. There's no cost to open it now, and all their trading costs would apply. If you watch the news, that just got a lot cheaper this week because there's a little war between some of the E-Trade and Schwab, and now TD Ameritrade have all lowered their costs. But you have to have at least $2,500 built up in the plan. At that point, you can transfer $1,000 or more over into it. And then the universe of investing, you have a lot more choices. So you could do individual stocks, individual bonds, exchange-traded funds, other publicly traded mutual funds. So if you still wanted fidelity, some specific fund, leveraged stock fund or something like that, you could actually access that through the self-directed brokerage window. You can access a lot of things. So that's another option as well. Any questions on the investment choices? No? Okay. Familiar with it. All right, so the education team has changed over time since we first started being record keeper, but now there's seven of us cover the state. Janice Parker actually covers this area now, but you may see her, 22nd, I believe? Janice will be here. But we do cover the state and provide education. If you do want to reach out to us, we'll go through that, but the numbers are here on the screen and on the website. Plan specialists, of course, if you do contact us, There are preset appointments online, there are webinars online, there are seminars online. But if you just want to get in touch with us, all that information, go to www.orphe.varetire.org/DCP. And if you click on education, you'll find our information, and there's a link to actually contact us or sign up. Educational resources, there is an overview guide or features and benefits guide for DCP. There's also a account access guide if you're having trouble with the web. That's online, as well as a lot of other information. You have an understanding your investment options. You have that investment guide that's on the table too. She mentioned the IOP that comes out monthly. That's online, but you will get that in your quarterly statements as well. And you do have fund profiles out there. So if you wanted to know what the top 10 holdings of the stock fund are, you could actually click on the fund profiles and see that information. All right, so we talked about fees earlier, so let's talk about the fees for the DCP plan. Really, there's only two types of fees. You have that flat record-keeping fee, that's all administration of the plan. It's $30.50 a year. It's deducted from your account value, $2.54 a month. Flat fee, which means the bigger your account gets, the less you pay for it percentage-wise. If you are participating in the Commonwealth of Virginia 457 plan, you've already paid that fee. You only pay it once for all the different plans that we offer. Same goes for the cash match if the cash match is going there. Beyond that, the only expense you have is your investment management expenses. That is on the far right-hand side of these performance sheets. If you're looking at the target date funds, they're all 0.08%, but they range from 0.01 to 0.58. The average is 0.13 for the DCP plan. So very low cost plan, and those are the only two expenses you would pay. Flat fee, and then that, unless you're in the self-directed brokerage account. So planning matters. Really, if you don't have a goal, most people here are in their second career, but if you're not sure how much you need at retirement, most people are spending 70 to 90% of what their working income is. Depending on your lifestyle and debt, I mean, it could be 100%. If you're very frugal, it could be less, but if you don't have a goal, you probably should aim for that number. If you haven't sat down with somebody and done some planning and run some numbers to see what you saved, are you on track? Know that you do have other saving opportunities out there, 403Bs as well as a 457 plan. You can save in both. You have the ability to save, max out both plans if you want to. But on this slide up here in this graphic, if you do find there's a shortfall, know the earlier you start, the better off you are, because of time and compounding. But they illustrate $50 twice a month or $100 a month, growing at 6% over different time periods. If you started at age 25 and put $100 a month, you'd have $191,000 saved up at 65. If you waited to 35 and then started doing that $100 a month, you'd have $97,570. If you started at 45, you'd have an additional $45,399. If you waited to 55, you'd have $16,267. So knowing time and compounding is on your side, but know you do have an avenue to save more if you need to. Account access, www.orphe.varetire.org/DCP, or you can just go to defined contribution plans and find optional retirement plan for higher education. For people who do everything on the phone, which I heard one person back there say that, we do have a phone app, and it's VRS DCP. You can get it on Google Play or App Store. Just remember VRS DCP. Download it. You have to have a login, but then you can contact us. You can manage your account. There's a lot of things you can do on your phone, pretty much everything. So if you want to connect with us at DCP, group meetings, individual appointments, that is out on the line. There's also our information. If you need to change things via customer service, we have a customer service line, of course. They're open 8:30 to 9, Monday through Friday, and there's a 24-hour automated line. And you can also manage your account online from that same website. So what we think is the difference really for DCP is, number one, very transparent fee structure, low-cost investment choices. You do have personalized service, whether you're still at work or you are retired. As long as you have money in one of these plans offered through VRS that we are record keeper for, we service it. So we have retirees we meet with as well as active employees. You have your 3 different investment paths to choose from, and you do have state-of-the-art tools, whether online or calculators and other things available to you. But most companies do at this point. So just some reminders, for new contributions, election October 1st through November 15th. If you need to change where your money is going or want to change, you have to do that during the deadline. Know that in January 2020, that is when your investments will start there. You may want to log in your account and change your investments at that point, but one thing you should definitely do if it's new is update your beneficiaries. And I joked about this the other day, but at least once a week I find somebody with nobody as a beneficiary. At least once a month I find somebody with an ex-spouse on there. And those are the horror stories you don't want to hear. Any life event or something that's a new plan, make sure you update those. And if you're sitting with a rep like myself, we can do that for you. All right, so at that point, I will field any questions, and we'll go on to the next provider. Any questions for me? No question. I must have done a thorough job then. Thank you.
Well, good morning. Thank you all for coming. My name is Matt Mead. I'm with TIAA, and this is my first time at VMI, so I'm really excited to be here. This is a really unique place. What I want to do, whoops, wrong way, is go through. We've covered, what's already been covered is the main points. You know what I mean? We know the timeline. We know what's going to happen. I just want to go through a few details about exactly what TIAA has and how we can help you. I think one thing that's very difficult is change. You know what I mean? Every so often, retirement plans go through changes, and it's always a little bit of a pain to have to understand new things and find out what your best choices are. So we want to make it easy for you. We want to help you any way that we can. So we're going to talk about the plan enhancement and updates. We'll talk about the new investment lineup. We'll talk a little bit about open enrollment and exactly what's going to happen. I think we've covered the timeline pretty specifically, and then go through the key dates once again. Most aspects of your plan is not going to change. If you're already with TIAA, what that means is essentially you don't have to do anything. You don't have to enroll in anything. If you're with TIAA and you're happy, you simply stay there. And what will happen for you is, beginning in January, there will be new investment lineups that you will have a choice from. But that's all. That's all that's going to happen. Of course, if you're with Fidelity, there is a change, and you're going to have a choice to make. And we definitely encourage you to give some thought to it. And if you don't make a choice, you will be defaulted. And if you decide that that's a good place for you, that's great. If you decide you want to use TIAA, it's a simple process to log on to the VRS log site, website and make that election. Now, who is TIAA? We celebrated our 100th birthday last year. TIAA was founded in 1918 by Andrew Carnegie as a way to help people in higher education better fund their retirement. We've operated as a nonprofit in that space ever since, and today we've expanded to include all kinds of different institutions, government, religious, etc. Higher education is still our bread and butter, but we've got over 5 million individual participants. We're the plan sponsor for over 15,000 institutions, and we've got over 1.1 trillion in assets under management. So TIAA has been around a long time, but the one thing that has never changed is our commitment to helping you fund your retirement and make good choices and how to make that happen. So let's talk a little bit about the new lineup that's coming with TIAA. It says you've got two choices, but the two choices refer to if you want to look at the investments within the plan. The third choice isn't mentioned here. We also have the brokerage option as well, but within the plan, you can either say, do it for me and use the target date, or you can say, I want to do it myself and look at the different investment options available to you. Target date funds, this has been covered once, but essentially, to kind of rehash it once again, the more time you have, the more aggressive the target dates are. If you're going to retire in 2060, it's going to be largely stock. If you're going to retire in 2020, it's going to be a lot less stock. But in every one of these portfolios, it's done for you. They grow more conservative over time, and it takes that burden off of you. I work with a lot of people in higher education, and what I can tell you is that the vast majority of them are so enmeshed in their work and their family and all their commitments, they just don't have the time to think about this stuff. So for them, if that's in your situation, a target date fund is a way you can set it, forget it, and put it on cruise control. Now, if you want to manage it yourself, that's great. And this is the chart based on your age, you know what I mean? So based on the year of birth, you're going to be approximately in those retirement years. Now, the one thing that is changing about the target date funds is that once you cross that threshold, you do move into the retirement portfolio managed by BlackRock. So that did not happen before, that is happening now. But regardless of where you fit, you are on cruise control and you're managed based on that target date. Now, what if you want to do it yourself and you want to build your own portfolio? There's a robust lineup giving you access to the very, very conservative all the way to the very aggressive and everything in between. Looking specifically at what's available here, I want to mention a couple things that are a little bit unique. Number one, our most conservative investment is the TIAA traditional. That's what we call our guaranteed account. While it does have a great yield and it has zero risk, you want to be very, very careful with that one because it is not a mutual fund which is liquid. So if you select that, be careful to know that you're committing yourself to either lifetime income or slow withdrawals over a number of years. Everything else out there is fully liquid. So it may be a good fit for you, it may not be, but please don't think it's a money market that's liquid, okay? And we've got short-term bond funds, regular bond funds. The TIAA real estate account is another very, very interesting option for you too. TIAA happens to be among the largest holders of commercial real estate in the world. We own vast expanses of farmland and commercial buildings and all that stuff. Real estate as an investment option serves this purpose. It is a way to help lower your risk. You know, real estate goes up and down in value, but it is not going up and down with the stock market. So it is what we call a non-correlating or a less correlating asset. We like using an alternative investment as a small percentage of the portfolio to help you lower your risk. And I think that the TIAA real estate account may be a good fit for a lot of you. Okay. Everything else is pretty much what you see. BlackRock is the sub-advisor for the equity index, the international, and of course the small and mid-cap fund as well. So you got a lot of great choices, very low-cost choices as well, to help you manage a good portfolio to meet your needs. Now, what about the brokerage option? In this case, you would have to request it. You've got a minimum of $2,500 you need to start to set that up. And then you can do stocks, you can do bonds, you can do, there are thousands of mutual funds that are available to you. The one thing I'd caution you here, though, is that whereas with the investment options that are in the plan, VRS has worked very, very hard to do the due diligence and make sure that they're good performing and low cost. You're giving up all that due diligence and you're putting that all on yourself if you use the brokerage. So if you've got the expertise, we definitely encourage you to use it. If there are investments you want to pursue that are not available in the plan, then the brokerage option is definitely the way to get those. But just be aware that there's nobody else watching out for you but yourself. It's totally taking that full risk yourself and making the decision for yourself. And for a lot of people, it's a good choice, but for a lot of people, it isn't. And this is the kind of thing that when we are available to talk to you, we're happy to talk about that and see if it's a good fit for you. We do have presence on campus here. We've got somebody who comes to VMI on a very regular basis. On the table there are these postcards, and if you'd like to schedule an appointment, you can fill that out and we'll reach out to you and get you on the calendar. So that's definitely an option for you. Yes?
Matt, I have a question. When would brokerage service fees apply? What type of transactions would trigger a brokerage service fee?
Oh, that's a great question. That's a great question. I think, typically when you're in a retirement plan, there are no costs for any transactions that you do. You buy this investment option, you sell this one, there's no cost. In a brokerage account, it doesn't work that way. While there are some no-fee mutual funds available to you, if you buy a stock, if you buy something that does involve a transaction, there is going to be some kind of fee that we have absolutely no control over. We are the broker-dealer for the brokerage option, so we're not using an outside provider, but there is definitely a cost when you buy a stock. It's like $6 or $7. The mutual funds may have fees, but they're going to be assessed by the mutual fund that you're buying, not by the brokerage account. So that's a good question, because there are definitely costs outside there that we don't have that much control over. talking a little bit about the fee structure. Our administrative cost is $66 per year, and it is assessed once per quarter. We do $16.50 per quarter, taken on a pro rata basis from each of your investments. So that again is something that is set regardless of the size of the account, and as Kelly had said, the cost is the same whether it's $1 million account or a $10,000 account, so we might as well charge the same amount for everybody. And that just is $66 per year. Now again, I'll go through the timeline a little bit here. Open enrollment is now October 1st through November 15th. That's when you would make a change. New contributions will go into whatever you selected beginning in January. And then if you are moving money over, and again with Fidelity it's going to be automatic. But then if you choose not to, you can choose not to move your Fidelity funds, you can leave them there. The movement will happen in February. So we've kind of gone over that timeline a few times here. I've got some more materials on my table there that kind of go through the mapping out of which funds are going from TIAA funds to BlackRock. You can look at that. If you're with Fidelity, there's one that specifically addresses the Fidelity mapping as well. So I encourage you to help those as well. And there's a little conference room over to the right. If anybody wants to meet with me one-on-one, I'll be happy to stick around and talk to you individually if you'd like. Covered that. We've covered all the timeline here. That's all that I had for you all. Again, thank you all very much. Any questions for me? Great. Well, thank you all very much.
Thank you.
So I'm just going to wrap up with some key dates. Many of these are really only applicable if you're with Fidelity. There's really not a lot of key dates if you are with TIA or DCP and you are staying with them. So I want to hit these highlights real quick and then we will wrap up. Now through November 15th is the open enrollment window. If you are with Fidelity, you need to select a new provider by November 15th. Again, just to reiterate, you do that online in MyVRS. Okay? During that process, you will have access to a form that you will fill out and send to VRS that indicates you want to leave your assets with Fidelity. That is the only purpose of that form, all right? If you do not submit that form, your assets will go to the provider you selected automatically, or if you didn't do anything, it's going to go to DCP, and your new provider will be DCP, okay? Any questions on that? Nope. All right. On or about January 3rd, you will be enrolled with your new provider. All right, so both TIA and DCP will be sending out enrollment notifications, welcoming you to their platform and telling you how to log into your account and all of that good stuff. That will happen right around the first of the year. Once you get that notification, that means you can log into your new account and select your investment options for your new contributions going forward. This is important, all right? Your contributions will start going to your new provider with your January 16th paycheck. So if you don't select any investment options, your money's going to go to a target date portfolio, either on the DCP platform or on the TIA platform. If you want it to go somewhere else, you need to log in before January 16th and tell them where you want the money to go. Okay? Assets will transfer, actually I'll come back to that, January 31st. If you have assets with Fidelity that is moving to a new provider, all right, meaning you did not send us a form. Okay, there will be a blackout period in your Fidelity account. What that means is that starting on January 30th, you can log into your account, but you won't be able to make transactions in your account. There will be no distributions processed after that point. You can't move money around within your investments. The blackout period is basically a period of time where we are letting everything settle so we know exactly what is going to be transferring and when, and there's very little activity going on in there, okay? So once that happens on January 30th, around February 7th, actually should be on February 7th, but the money will leave Fidelity and go to whoever your new provider is. So at that point, you will have a zero balance in your Fidelity account, okay? You'll get a notification from them saying you have a zero balance in your account. Don't be alarmed, that's supposed to happen. Your money is moving to your new provider, and around January or February 13th, you will see that money in your new provider account, okay? And you'll get a notification from them confirming receipt of it. All right? That money will transfer based on the mapping tables. So TIA has an excerpt with that information on their table, so does DCP, and it's laid out in this Fidelity insert. All right? And this will tell you if you have money in this Fidelity fund, it's going to land either at DCP or TIA in whichever fund on that lineup. Okay? And so that will happen. Blackout period will lift entirely around the 13th of February, and you will be able to log in and move that money around to different investments if you would like. Okay? Had a handful of questions come in. When can I log in and do beneficiaries? When can I log in and do my investment elections? After the first of the year, you can log in and do all of that stuff. Okay? All right. So congratulations, you've made it to the end of this very, very long presentation. Are there any questions that I haven't addressed or TIA or DCP hasn't addressed? This is what we are here for today. And again, just as a reminder, if you have colleagues that weren't able to make it, the information is recorded and available online for them to review. And VMI is actually doing a recording of this actual presentation as well. So that will be helpful. Okay, so with that, I'm done. Thank you guys for your time. I appreciate it.